Aloha and welcome back. We're on chapter 11 and I gotta kind of apologize today. I'm a little under the weather, but I don't want to fall too far behind in doing these videos, so I thought I would prepare one today. You know, chapter 11 on corporate equity is, again, I mentioned it before, probably one of the more difficult chapters in the course. I think it's between this one, chapter 11, and chapter 7 on inventory costing methods, but either way, this material can be pretty difficult to digest and understand, but we'll give it a shot. We'll give it the best shot we can. And you know, there's so much information presented in this chapter on corporate equity, and so it makes it very difficult to try to cover all the bases, all the concepts, and all the terminology and so forth. And so, you know, I kind of need to focus in on 2 or 3 things, and hopefully that'll give everyone a fairly good basis to move forward from and, you know, complete the chapter. This is just one chapter in the course. So what I thought I would do is problem PA11-1, which is one of our assigned problems for the course. And again, I've done a couple of problems in earlier lessons. I just want to remind you that the problems from the textbook are the exact same problems that you'll see on the Connect homework site. But of course, all the numbers on the Connect site will be different. So those problems are all algorithmic. Same problem, different numbers for each person. So, on page 545, PA11-1, Global Marine obtained a charter from the state in January 2010. So they were incorporated in January 2010, and their authorized stock by corporate charter, they were authorized to issue 1 million shares of $5 par value stock. Again, par value is an arbitrary amount. It has no significance except that it is used to calculate the credit to the contributed capital, or in this problem we're using a little different name for that account, contributed capital or common stock account. So that's where the par comes into play. During the first year, the company earned $429,000. So that was its net income on its income statement. And there are a couple of transactions. They issued 700,000 shares. Of the million authorized shares, they issued or sold 700,000 shares at a price of $54 a share. And then at some later date during the year, they reacquired or repurchased 25,000 shares at $50 a share. And it says that the reason for the repurchase of stock was to use as stock incentives for senior management. So this would be one of many reasons why corporations would want to buy back outstanding shares of stock. And so under required, number 1, it asks us to indicate the effects of each transaction on the accounting equation. I'm going to skip that, and I'm just going to go to the journal entries, which is the second requirement. Because when we do the journal entries, I think the effects on the accounting equation are pretty evident. So to record the issuance of 700,000 shares at $54 a share, we would debit cash, and to get this amount, $37,800,000, we would multiply 700,000 times $54 a share. So that's the amount of cash collected on the sale of that stock. The credits, again, as we discussed in the previous lesson, the credits are a little tricky. We use the par value to calculate the credit to the common stock account, or if we go back to the previous lesson, the account title I used was contributed capital. Same account. Excuse me. Here we're using common stock as the account title. So that's 700,000 shares at par value of $5 a share. 3,500,000. And the difference, again, if we take the price, subtract the par, in the previous lesson I called that the premium. And in the previous lesson, the account title I used was contributed capital in excess of par. In this problem, the account title I'm using is a little different, but again, it's the same account. Here I'm using additional paid-in capital. Additional paid-in capital. And you could add to that account title if you wanted to, in excess of par. That's basically what it is. So we would subtract par from the price, $54 minus 5, and that gives us $49. And then we multiply $49 times the 700,000 shares to get the amount of this credit to the additional paid-in capital account, $34,300,000. I hope that makes sense. Now, when I was preparing this solution, after this journal entry, I went right down to requirement 3, and what I forgot to do was journalize the second transaction. And so I've journalized the second transaction on the back side of the sheet. And the second transaction was to show that they reacquired or repurchased 25,000 shares at $50 a share. So we call that a treasury stock transaction. They are buying back stock that has been sold and has been outstanding, now being bought back and held by the corporation. And so we use the cost method to record this entry, which basically says we take the number of shares and multiply it by the price that we paid our shareholders to get the stock back. So 25,000 shares times $50 a share. We debit the treasury stock account. Treasury stock, again, if you recall from the previous lesson, is a debit balance equity account, kind of a contra equity account. It's not an asset, it's a debit balance equity account or a contra equity account. It reduces total stockholders' equity. So we debit the treasury stock account for $1,250,000 and we credit cash because we are paying cash to reacquire that stock. Now, we can go to the third requirement, and it is asking us to show the prepare the stockholders' equity section of the balance sheet as of December 31, 2010. And so this is just the equity section of the balance sheet. We break our equity up into two groups, basically. Equity that is contributed, or equity that comes from the owners, comes from outside the corporation, from the owners. We refer to that as contributed capital. And the other portion of the equity for a corporation is our retained earnings. That is internally generated capital. And again, retained earnings is the accumulation of net incomes of the business moving forward over time. Of course, if the business incurs a net loss in any year, then the net loss would be a reduction of the retained earnings account. And that transfer to retained earnings of the net income or the net loss is done at the end of the year at closing. So, for contributed capital, we show common stock, $5 par. We show 1 million shares authorized, 700,000 shares issued or sold, and then finally we also show less 25,000 shares in the treasury. So it's a lot of information that we show on the balance sheet in the equity section. And the total is $3,500,000, which would come from that account. And if you recall, that was our credit in this journal entry, $3,500,000. Our next account in the equity section under contributed capital would be the additional paid-in capital. And that amount is at $34,300,000. And then we add the two together to get a subtotal total contributed capital of $37,800,000. And then at that point we switch to retained earnings or internally generated capital, and we show the retained earnings account balance, which at the end of the first year just reflects the amount of retained earnings for the first year, which is $429,000. And then we total those two amounts. So we come up with total equity before reduction of treasury stock. Total equity of $38,229,000. And then we show the reduction in equity for the treasury stock. So less treasury stock at cost. And again, our treasury stock account was debited at cost $1,250,000. That was 25,000 shares at $50 a share. So after subtracting the treasury stock total, we come down to total stockholders' equity at December 31, 2010 of $36,979,000. Again, this is one of the assigned problems. So when you work on it in Connect, it'll be the same problem except with different numbers. I think we have a few minutes here, maybe a minute or so. Let's see if there's any other comments I could add to this discussion. Again, there's so much information included in this chapter. You know, we haven't even begun to talk about preferred stock, preferred versus common stock. That's a whole other topic. Dividends is a topic unto itself. There are cash dividends and there are stock dividends. We also have stock splits. A lot of information. I think for now I'll close this lesson, and depending on the kind of feedback I get from students once we start on this chapter, maybe I'll add a lesson or two to the list on La Lima. Thank you for your attention, and again I apologize for my voice being under the weather all day today, and so I hope this has been helpful. Thank you.